What if I told you the government has actually created perfectly legal pathways for you to pay less in taxes? Most people miss these opportunities simply because no one taught them how the tax game really works. Today, I'm sharing the exact strategies I wish someone had told me about in my 20s. We'll cover everything from retirement account hacks to investment moves that could potentially save you thousands each year and transform your relationship with taxes from fear to strategic advantage. The tax fear factor: why most women avoid tax planning. Did you know that tax anxiety affects women more than men, with studies showing we're 80% more likely to feel overwhelmed by tax paperwork? That statistic stopped me in my tracks when I first read it, but honestly, it didn't surprise me. I've seen this tax avoidance pattern play out with friends, family members, and even in my own life for years. Here's what typically happens. Tax season approaches, and that knot forms in your stomach. You push off thinking about it because, well, taxes are complicated and intimidating. The forms look like they're written in another language, and making a mistake feels catastrophic. So what do most of us do? We put it off until the last minute, file as quickly as possible, and try not to think about it for another year. But this avoidance cycle is costing us real money. When we rush through our taxes or hand them off to someone else without understanding what's happening, we miss opportunities to save. The average American woman leaves thousands of dollars on the table each year in unclaimed deductions, credits, and strategic tax moves. That's money that could be going toward your emergency fund, retirement, or that trip you've been dreaming about. What's particularly frustrating is that the tax code's complexity isn't an accident. It's intentionally complicated, creating a barrier that benefits those who can afford specialized help while leaving everyone else feeling overwhelmed. When systems are complex, our natural response is often avoidance rather than engagement. This fear response is completely normal. Your brain is trying to protect you from what it perceives as a threat. For women specifically, there's another layer to this. Many of us were raised with subtle or not so subtle messages that money matters are complicated or not for us. Think about how often financial tasks were divided in the households where you grew up. Who handled the taxes? Who made investment decisions? These patterns run deep, and they shape how comfortable we feel taking control of our financial lives. But here's the shift that changed everything for me. What if we started thinking about taxes not as an obligation, but as a strategic game with clear rules? Games have winners and losers, and I don't know about you, but I prefer winning. I remember the exact moment this clicked for me. I was in my late 20s, handing over my tax documents to an accountant my friend had recommended. He asked if I had made any charitable donations that year. I had, quite a few actually. When he showed me how much those donations reduced my tax bill, I was shocked. Then he asked about my side business expenses, my retirement contributions, and several other items I'd never considered tax-related. By the end of our meeting, he had found over $3,400 I would have overpaid if I'd filed the way I always had before. That was my light bulb moment. I realized I had been playing the tax game all along. I was just playing it poorly because I didn't understand the rules. My fear had been costing me thousands of dollars every year. The more I learned, the more I realized that tax strategy isn't about memorizing the entire tax code or becoming an accountant. It's about understanding just enough of the rules to make smart decisions throughout the year. It's about knowing when to make certain money moves and when to hold off. Most importantly, it's about deciding to engage with the system instead of avoiding it. The first step to saving on taxes isn't learning complicated rules. It's simply deciding to play the game. When you make that mental shift from victim of the tax system to strategic player within it, everything changes. You start seeing opportunities instead of obligations. You begin to recognize that every financial decision you make has tax implications, and that knowledge is power. Now let's look at what the game board actually looks like, and why understanding it matters so much. Understanding your tax bracket, the game board you're playing on. The tax game board I mentioned? It's actually a colorful collection of tax brackets that most people seriously misunderstand. Ever heard someone say they don't want a raise because it would put put them in a higher tax bracket? This costly misconception is leaving money on the table for millions of women each year. Let me break down how tax brackets really work with a simple water bucket analogy. Imagine you have several buckets lined up, each with a different price tag on it. The first bucket costs very little to fill, 10%, the second costs a bit more, 12%, and each subsequent bucket costs progressively more. Your income is like water flowing into these buckets. It fills the first bucket completely, then overflows into the second, and so on. Here's the crucial part. Only the water in each specific bucket gets charged at that bucket's rate. For 2024, if you're a single filer, your first $11,000 of income only gets taxed at 10%. Then your income from $11,001 up to $44,725 gets taxed at 12%. Income from $44,726 to $95,375 gets taxed at 22%. The pattern continues with higher brackets at 24%, 32%, 35%, and finally 37% for income over $578,125. Head of household filers, usually single parents, get slightly better brackets, 10% on the first $15,700, 12% on income from $15,701 to $59,850, and so on. Here's where people get confused. If you earn $60,000 as a single person, you're technically in the 22% tax bracket, but that doesn't mean all your income is taxed at 22%. Only the portion above $44,725 gets hit with that 22% rate. Your first $11,000 is still only taxed at 10%, and your income between $11,100 and $44,725 is taxed at 12%. This difference is called your marginal tax rate versus your effective tax rate. Your marginal rate, 22% in this example, only applies to the next dollar you earn. Your effective rate is the average rate you actually pay on all your income combined, and it's always lower than your marginal rate. Let me share Emma's story. She was offered a promotion that would raise her salary from $44,000 to $48,000. She nearly turned it down because she thought crossing into the 22% bracket meant all her income would suddenly be taxed at 22% instead of 12%. Emma worried she might actually take home less money after the promotion. The truth? Only the $3,275 that exceeded the 12% bracket threshold would be taxed at 22%. That's just $721 in tax on that portion, leaving her with thousands more in take-home pay. Had she declined that promotion based on this misunderstanding, she would have left serious money on the table. Not just for that year, but potentially affecting her earning trajectory for years to come. Understanding your tax brackets doesn't just prevent mistakes like Emma's, it creates opportunities for strategic moves. For example, if you know you're near the top of a bracket, you might choose to defer some income to the next year or accelerate deductions into the current year. The standard deduction is also key to understanding your actual taxable income. For 2024, single filers can subtract $14,600 from their income before even applying tax brackets, while head of household filers can subtract $20,800. This effectively creates a 0% tax bracket for your first chunk of income. When you truly understand how tax brackets work, you gain the power to time your income and deductions strategically. Maybe you realize it makes sense to bunch your charitable donations in alternating years to exceed the standard deduction. Or perhaps you decide to accelerate income into a year when you're in a temporarily lower bracket. The retirement account advantage, your first power move. Strategic timing of income and deductions is a powerful start, but there's an even more immediate way to shrink your tax bill. What if the government had created special accounts where every $100 you contribute immediately saves you $22 in taxes? These accounts exist, and they're hiding in plain sight. They're your traditional retirement accounts. When we talk about 401ks and traditional IRAs, most people think about saving for their golden years. But they're missing the powerful tax advantage these accounts offer right now. These aren't just retirement vehicles, they're immediate tax reduction tools that can put money back in your pocket each year. Here's the surprising reality. Only 36% of women aged 25 to 34 are actively contributing to retirement accounts, compared to 45% of men in the same age bracket. Many young women put off retirement planning because it feels so far away, or they believe the myth that you need to have extra money to invest. But this thinking is costing them thousands in unnecessary taxes each year. Let me show you how this works with real numbers. In 2024, you can contribute up to $23,000 to a 401k if you're under 50 years old. For those 50 and over, that limit jumps to $3,500 with the catch-up contribution. For traditional IRAs, the limits are $6,500 for those under 50 and $7,500 for those 50 and above. Now, here's the tax magic. Every dollar you put into these traditional accounts reduces your taxable income by exactly that amount. If you're in the 22% tax bracket we discussed earlier, contributing $10,000 to your 401k immediately saves you $2,200 in federal taxes. That's money that stays in your pocket instead of going to the IRS. Let's look at a concrete example. Say you earn $60,000 a year and decide to contribute $6,000 to a traditional IRA. Your taxable income drops to $54,000, which could save you around $1,320 in federal taxes if you're in the 22% bracket. That's like getting a 22% discount on your retirement savings. But it gets even better. Many employers offer matching contributions to your 401k. On average, companies match 50% of employee contributions up to 6% of your salary. That's essentially free money on top of your tax savings. Yet surprisingly, about 70% of employees don't take full advantage of their employer's match. They're literally leaving money on the table twice, paying more in taxes and missing out on employer contributions. Take Jasmine, for example. She earns $75,000 annually and was initially contributing just 3% to her 401k. After learning about the tax advantages, she increased her contribution to the maximum. This reduced her taxable income significantly and saved her $4,200 in taxes for the year. Plus, her employer match added another $3,750 to her retirement account, money she wouldn't have received otherwise. What's particularly concerning is that women in their 20s and 30s are less likely to participate in employer-sponsored retirement plans than men. Only 29% of women aged 25 to 34 have access to a 401k plan, compared to 38% of men. This gap creates both an immediate tax disadvantage and a long-term retirement savings shortfall. Calculating your potential tax savings is straightforward. Multiply your contribution amount by your tax bracket percentage. If you're wondering how much you could contribute without feeling it in your monthly budget, try starting with just 1% more than you're currently saving, then increase it by another 1% every few months. Many people find they barely notice the difference in their take-home pay. The Roth strategy: tax-free growth for your future self. Those immediate tax savings from traditional accounts feel good now, but they might not be the best long-term play. Think about this. The average woman lives almost 5 years longer than the average man, yet has 30% less saved for retirement. Could choosing a different type of retirement account actually help close this gap while eliminating future tax worries completely? When we talk about retirement accounts, there's a fundamental choice to make. Do you want to pay taxes now or later? With traditional accounts, you're essentially telling the IRS, "I'll pay you later." Your contributions reduce your taxable income today, but you'll pay taxes on every dollar you withdraw in retirement. Roth accounts flip this arrangement. You contribute after-tax dollars now, but everything comes out completely tax-free in retirement, including all your investment growth. This difference might seem subtle, but the long-term impact is anything but. Let's look at what happens with $6,000 invested in a Roth IRA at age 25. If that money grows at an average annual return of 7% for 30 years, by age 55, it would grow to approximately $63,000. With a traditional account, you'd owe taxes on that entire amount when you withdraw it. But with a Roth, every penny is yours to keep, tax-free. The math gets even more compelling when you think about longer time frames. If you're in your 20s or early 30s, you have a unique advantage: time. You're likely in a lower tax bracket now than you will be later in your career, which means paying taxes now rather than later is mathematically advantageous. You're essentially locking in your current lower tax rate instead of gambling on what future tax rates might be when you retire. For women specifically, this strategy addresses a critical retirement challenge. Because women typically live longer, their retirement savings need to stretch further. Having a source of completely tax-free income in those later years can make a significant difference in quality of life. Let me share a quick story about Taylor. She started contributing just $3,000 annually to her Roth IRA from age 25 to 35. That's only 10 years of contributions. Even if she never added another penny after age 35, that money, growing at 7%, could potentially grow to over $1 million by age 65. And she won't pay a single cent in taxes when she withdraws it. That's the magic of tax-free compounding over decades. Now, there are income limits to be aware of. In 2024, if you're single and your income exceeds $153,000, or you're married filing jointly with income over $228,000, direct contributions to a Roth IRA start to phase out. This is where many successful women hit a roadblock, but it doesn't have to be the end of your Roth strategy. There's actually a completely legal workaround called the Backdoor Roth, which we'll explore in detail in the next section. What makes the Roth strategy particularly powerful for women is how it addresses long-term financial security. Women face unique retirement challenges, career breaks for caregiving, longer lifespans, and often lower lifetime earnings. A tax-free income stream in retirement can help mitigate these challenges. It's not just about avoiding taxes, it's about creating financial certainty in your later years. The Backdoor Roth IRA, the secret passage for higher earners. Just when you think your high income has disqualified you from enjoying those amazing Roth benefits, there's actually a secret passage in the tax code hiding in plain sight. This two-step process has helped women like Morgan, a marketing director earning well above the income limits, build a tax-free nest egg that ultimately funded her first home purchase. Those income limits we talked about earlier, $153,000 for single filers in 2024, can feel like a brick wall for successful professionals. But here's what most financial advisors won't proactively tell you. There's a perfectly legal workaround called the Backdoor Roth IRA that lets you bypass these restrictions entirely. Think about it. You've worked hard to reach a comfortable income level, only to discover you're now excluded from one of the best tax advantages available. That's exactly what happened to Morgan, who was frustrated when her financial advisor simply told her she made too much money to contribute to a Roth IRA. It wasn't until she switched advisors that she learned about the backdoor option that had been available all along. So how does this backdoor strategy actually work? It's surprisingly straightforward, just two main steps. First, you contribute to a traditional IRA with after-tax dollars, meaning you don't take a tax deduction. Then, you convert that traditional IRA to a Roth IRA. Since you've already paid tax on the money, there's typically no additional tax due on the conversion itself. The end result? You now have money in a Roth IRA that will grow completely tax-free, regardless of your income level. But there's an important catch that trips up many people, something called the pro rata rule. If you already have money in traditional IRAs, including SEP or simple IRAs, the IRS doesn't let you cherry-pick which dollars you're converting. Instead, they look at all your traditional IRA balances combined when calculating how much tax you owe on the conversion. Let me explain this with a quick example. Say you have $50,000 in an existing traditional IRA from an old 401k rollover, pre-tax money, and you add $6,000 in new after-tax contributions for the backdoor strategy. When you convert that $6,000, the IRS considers that 10.7% of your total IRA balance, $6,000 out of $56,000, is after-tax money. That means only 10.7% of your conversion would be tax-free. You'd owe taxes on the remaining 89.3%. This is why the backdoor Roth strategy works best for people who either don't have existing traditional IRA balances or who can roll those balances into their current employer's 401k plan before implementing the strategy. The statistics on this are pretty striking. According to tax experts, only about 5% of eligible high earners take advantage of the backdoor Roth IRA strategy simply because they don't know it exists or feel intimidated by the process. For Morgan, learning about this strategy changed everything. As a marketing director earning $185,000 annually, she was well beyond the income limits for direct Roth contributions. But by using the backdoor approach consistently for 5 years, she accumulated enough for a substantial down payment on her first home, all of which she could withdraw tax and penalty-free, since Roth contributions can be taken out at any time. The IRS has clarified that this strategy is completely legitimate, though they do emphasize the importance of following the pro rata rule correctly to avoid unexpected tax bills. And while there are occasional discussions in Congress about closing this loophole, it remains available to savvy investors for now. Catch-up contributions, making up for lost time. The tax code isn't just full of restrictions, it also contains hidden gifts for those who've taken detours in their working lives. If you've ever worried about falling behind on retirement savings because of career breaks, family care, or other life priorities, the government actually gives you a second chance that most women never take advantage of. When you reach age 50, the IRS essentially rewards you for getting older by allowing you to contribute significantly more to your retirement accounts. These additional allowances are aptly named catch-up contributions, and they're specifically designed to help those who need to make up for lost time. For 2024, if you're 50 or older, you can contribute an extra $7,500 to your 401k, on top of the regular $23,000 limit. That brings your total possible contribution to $30,500 in a single year. For IRAs, you get an additional $1,000 on top of the standard $6,500 limit, bringing your total to $7,500. Combined, that's an extra $8,500 in tax-advantaged savings opportunities every year after you hit the big 5 arrow. The tax benefits here are substantial. Let's say you're in the 24% federal tax bracket. Maximizing these catch-up contributions could reduce your tax bill by over $2,000 annually. Even if you can only manage part of these amounts, every dollar counts toward both your retirement security and immediate tax savings. What many women don't realize is that these catch-up provisions acknowledge a common reality, that careers aren't always linear, especially for those who take time away from the workforce to raise children or care for aging parents. The tax code is actually giving you a mechanism to recover some of those lost years of retirement saving. And here's something even more exciting that's just around the corner. Starting in 2025, the Secure 2.0 Act will introduce a special catch-up provision specifically for people ages 60 to 63. This will allow for even higher contributions, up to $10,000 for 401k plans, with specific amounts for IRAs still being finalized. This 4-year window will provide an unprecedented opportunity to supercharge your retirement savings while significantly reducing your tax burden. I want to share Patricia's story because it perfectly illustrates the power of this strategy. After taking a decade-long career break to raise her children, Patricia returned to the workforce at age 52. She felt anxious about her retirement savings, which had stagnated during her time away from paid work. Her financial advisor recommended she take full advantage of catch-up contributions. By maximizing both her regular and catch-up amounts to her 401k and IRA, Patricia was able to reduce her tax bill by $1,300 in her first year back at work. I didn't expect the tax code to have provisions that seemed tailor-made for someone in my position, Patricia said. It felt like finally getting credit for all those years of unpaid caregiving work. What's especially valuable about catch-up contributions is that they work in tandem with all the other retirement strategies we've discussed. You can use them alongside traditional accounts for immediate tax deductions, or with Roth accounts, including backdoor Roth strategies if you prefer tax-free growth and withdrawals later. Even if you can't manage the full amounts, think about gradually increasing your contributions each year. Even an extra 1 to 2% of your salary directed toward these catch-up opportunities can make a substantial difference over time. The capital gains advantage. Why investment income gets special treatment. While retirement accounts offer tax advantages for your work income, there's another type of income that gets even better treatment from the IRS. Did you know there's a type of income where you could make up to $47,625 in 2024 and pay absolutely zero federal taxes on it? It's not a trick or loophole. It's built right into the tax code, waiting for you to claim it. Your paycheck and your investment gains are taxed completely differently. The money you earn from your job is considered ordinary income. And as we've seen, it gets taxed at rates ranging from 10% all the way up to 37%. But money your money makes for you, that's called capital gains, and it gets special treatment. The tax code heavily favors investment income over the money you earn from working. While you might be paying 22% or 24% on your salary, your investment gains could be taxed at just 0%, 15%, or 20%, depending on your total income. That's a massive difference that can save you thousands of dollars each year. For 2024, here's how the capital gains tax brackets work. If you're single and your taxable income is under $47,625, you'll pay 0% on your long-term capital gains. Yes, you read that correctly. Zero federal taxes. For income between $47,625 and $492,300, the rate jumps to 15%. And if your income exceeds $492,300, you'll pay 20%. For married couples filing jointly, the 0% rate extends even further, up to $89,250 of taxable income. That means a married couple could potentially realize nearly $90,000 in capital gains and not owe a penny in federal taxes on that money. This is especially valuable for women building wealth. Think about it. If you're strategic about when you sell investments, you could potentially cash in significant gains without increasing your tax bill. Most women don't realize they can intentionally harvest gains within this 0% bracket. There's an important distinction between short-term and long-term capital gains. Investments held for less than a year are considered short-term and are taxed at your ordinary income rate, those higher rates we talked about earlier. But hold that same investment for just over a year, and it qualifies for those preferential long capital gains rates as low as 0%. Let me tell you about Zoe, who runs a small online business selling handmade jewelry. She earns about $40,000 a year after deductions. Instead of keeping all her business profits in cash, Zoe invested some money in stocks a few years ago. This year, she wanted to sell some investments that had gained $15,000 in value to expand her workshop. Because Zoe's total income, including her $15,000 in capital gains, still kept her under the $47,625 threshold, she paid absolutely no federal tax on those gains. If she had earned that same $15,000 through additional sales in her business, she would have paid over $1,800 in federal income tax on it. Here's where strategic thinking comes in. You can intentionally time when you sell investments to take advantage of years when your income might be lower. Maybe you're taking time off for education, working part-time, or between jobs. These could be perfect opportunities to realize some gains without the tax hit. Statistics show that only 28% of women invest in the stock market compared to 43% of men. This means women aren't just missing out on building wealth through investments, they're also missing the tax advantages that come with it. Why are so many women missing out on the 0% capital gains tax bracket? Because they don't realize they can strategically recognize investment gains without paying any federal tax, as long as they stay under those income thresholds. The tax code rewards those who understand its nuances, and this is one of the most powerful advantages available. Tax loss harvesting, turning market downturns into tax wins. The tax code isn't just about minimizing taxes on your gains, it's also about making the most of your losses. When the market takes a downturn and your portfolio shows some red, most investors simply wait it out or panic sell. But what if those losses could be strategically used to put money back in your pocket while keeping your investment plan on track? That's exactly what tax loss harvesting allows you to do. It's a powerful strategy that transforms market downturns from purely negative experiences into opportunities for tax savings. Think of it as finding the silver lining in those investment clouds. Here's how it works. When an investment you own falls below what you paid for it, you can sell it and recognize that loss for tax purposes. These losses can then directly offset any capital gains you've realized from selling other investments at a profit. What makes this even more valuable is that if your losses exceed your gains, you can use up to $3,000 of those remaining losses to reduce your ordinary income. Yes, the money you earn from your job or business. What happens if you have more than $3,000 in losses after offsetting all your gains? The IRS allows you to carry those excess losses forward to future tax years. This means a significant market downturn could provide you with tax benefits that last for years to come. The beauty of tax loss harvesting is that it doesn't mean abandoning your investment strategy. After selling an investment at a loss, you can immediately reinvest that money in a similar, but not identical, security. This allows you to maintain your market exposure and asset allocation while still capturing the tax benefit. But here's where many investors slip up. The wash sale rule. This IRS regulation prevents you from claiming a tax loss if you purchase the same or substantially identical security within 30 days before or after selling at a loss. For example, if you sell shares of a technology ETF at a loss, you can't immediately buy the exact same ETF. However, you could purchase a different technology ETF with similar exposure, but tracked by a different index. Let me share how this worked for Maya during the 2022 market downturn. When several of her growth stock investments dropped significantly in value, instead of just holding and hoping they'd recover, she strategically sold positions that had fallen 30% below her purchase price. She captured about $16,000 in capital losses. Maya had realized some gains earlier that year from selling a rental property, so she used $10,000 of her investment losses to offset a portion of those gains. She then applied the maximum $3,000 against her salary income, saving approximately $2,400 on her taxes based on her tax bracket. The remaining $3,000 in losses was carried forward to use in future tax years. But here's the important part. Maya didn't just stay in cash after selling. She immediately reinvested in similar but not identical investments, maintaining her growth strategy while avoiding wash sale issues. When the market eventually rebounded, her new positions recovered alongside the broader market. You might be wondering how to spot these opportunities in your own portfolio. The best approach is to regularly review your investments for positions showing unrealized losses, especially during market corrections or after sector-specific downturns. Many brokerages now offer tools that help identify tax loss harvesting opportunities, and some even provide automated services that handle the process for you. Remember that tax loss harvesting is most effective in taxable investment accounts, not in tax-advantaged accounts like 401ks or IRAs where you can't claim losses for tax purposes. Strategic investment timing, when to sell matters. While tax loss harvesting works wonders during market downturns, timing your winners can be just as powerful. The day you choose to sell a profitable investment could mean the difference between keeping thousands of dollars in your pocket or handing it over to the IRS. Two identical sales, just days apart, might create dramatically different tax consequences. Most investors put all their energy into deciding what to buy and when to buy it. They research companies, analyze trends, and create careful entry strategies. But when it comes to selling, decisions are often reactive, based on reaching a target price or needing cash for an expense. What many miss is that the timing of when you sell has enormous tax implications. Here's why timing matters so much. When you sell an investment in December, you'll pay taxes on those gains in that tax year. But if you wait just a few days and sell in January, you've effectively pushed that tax bill an entire year into the future. That's a full year where that money stays in your pocket, earning returns instead of sitting in the government's account. This timing strategy becomes even more powerful when you coordinate sales with your overall tax situation. Let's say you know you'll be earning less next year. Maybe you're planning to take time off, switch careers, or start a business. Waiting to sell profitable investments until your income is lower could drop you into a lower capital gains tax bracket, potentially cutting your tax rate significantly. Year-end is prime time for strategic tax moves. December is when you should be looking at your portfolio alongside your tax projection for the year. This is when gain-loss netting becomes valuable, matching up your winners with any losers to minimize the taxable impact. Remember, if you've had losses earlier in the year, you can use those to offset gains from your winning investments. Your personal life events should also guide your investment timing decisions. Major expenses like buying a home, paying for education, or medical costs can temporarily lower your taxable income or qualify you for deductions that might make it an ideal time to recognize investment gains. The key is thinking about these decisions together, rather than in isolation. I want to share Aisha's story, which perfectly illustrates the power of strategic timing. Aisha had invested in a tech company that had grown substantially over 5 years. By December, she was ready to sell and use the profits toward a home down payment. After consulting with her tax advisor, she realized that selling in December would push her into a higher tax bracket for that year, resulting in a 15% capital gains rate. However, by waiting just a few weeks and selling in early January, her gains would be taxed in the following year when her other income would be lower. This simple timing shift saved her $3,800 in taxes, money that went directly toward her home purchase instead of to the IRS. Creating a personal tax calendar can help you make these decisions more systematically. Mark important dates like estimated tax payment deadlines, but also periods when you might expect income changes or major expenses. This calendar becomes your roadmap for optimal investment decision timing, helping you avoid reactive selling that could cost you thousands in unnecessary taxes. The difference between good and great investment returns often comes down to how much you keep after taxes. Research has shown that investors who strategically time their sales could potentially increase their after-tax returns by as much as 50% compared to those who ignore tax implications. That's not just a small optimization, it's potentially thousands of dollars in your pocket rather than the government's. Charitable giving strategies, doing good while saving on taxes. Tax planning doesn't just apply to your investments. It can transform your giving too. While most people think of charitable donations purely as acts of generosity, they're also powerful tax-saving opportunities when approached strategically. Let's talk about how you can maximize both your impact and your tax benefits when supporting causes you care about. When you donate to charity, the government essentially subsidizes your generosity through tax deductions. If you're in the 22% tax bracket and donate $1,000 to your favorite nonprofit, you could save $220 on your taxes, meaning your actual out-of-pocket cost is just $780. That's money back in your pocket for doing something good in the world. Here's the challenge, though. With the standard deduction at $14,600 for single filers in 2024, many women miss out on these tax benefits entirely. If your charitable giving and other itemized deductions don't exceed that threshold, you won't see any tax benefit from your donations. This is where strategic bunching comes in, a technique that can transform how you give. Bunching means concentrating multiple years of charitable giving into a single tax year to exceed the standard deduction. Instead of giving $5,000 annually for 3 years, which might never exceed the standard deduction, you could give $15,000 in 1 year, itemize your deductions that year, and then take the standard deduction in the following 2 years. Let me tell you about Layla, who discovered this strategy and transformed her giving approach. She typically donated about $6,000 annually to her favorite environmental organizations. After learning about bunching, she decided to combine 3 years of donations, $18,000, into a single tax year. This pushed her well above the standard deduction threshold when combined with her other itemizable expenses. The result? She saved $30,200 in taxes compared to her previous yearly giving pattern. "I was making these donations anyway," Layla said. "But by changing when I gave, I created a significant tax benefit without changing how much I gave overall." Another powerful strategy is donating appreciated investments instead of cash. This creates a double tax benefit that cash donations simply can't match. Here's how it works. When you donate stock or other investments that have increased in value, you avoid paying capital gains tax on the appreciation while still getting a deduction for the full market value. For example, imagine you purchased stock for $5,000 that's now worth $10,000. If you sold it and donated the cash, you'd first pay capital gains tax on that $5,000 gain. But by donating the stock directly to the charity, you avoid that tax entirely while still getting a $10,000 deduction. The charity can then sell the stock tax-free. This strategy works especially well for investments you've held for more than a year. Remember that documentation is critical to actually receiving these tax benefits. For cash donations under $250, a bank record, receipt, or other reliable written record is sufficient. For donations over $250, you'll need a written acknowledgement from the charity. Non-cash donations over $500 require completing Form 8283 with your tax return, and items worth more than $5,000 generally require a qualified appraisal. Women are statistically more likely to engage in charitable giving than men, donating a higher percentage of their income to charity. Knowing these tax strategies allows you to maximize your generosity while minimizing your tax burden. For those approaching retirement, there's another powerful strategy worth noting. Starting in 2024, you can donate required minimum distributions, RMDs, from retirement accounts directly to charities. This qualified charitable distribution, QCD, allows you to satisfy your RMD requirements while excluding that amount from your taxable income, a significant benefit even if you don't itemize deductions. Donor-advised funds, the ultimate charitable tax strategy. The surprising truth about donor-advised funds is that they let you have your own mini charitable foundation for a fraction of the cost. Think of it as a charitable savings account, where you get the tax break now, but decide which charities receive your money later, even years later. Donor-advised funds solve one of the biggest problems with charitable giving, the timing issue. Remember how bunching donations into a single year can help you exceed the standard deduction? Well, donor-advised funds take this concept to the next level. You can make one large contribution to your fund, claim the full tax deduction immediately, and then take your time deciding which charities will receive your money. Setting up a donor-advised fund is surprisingly simple. Many financial institutions like Fidelity, Vanguard, and Schwab offer them with initial contributions starting at around $5,000 to $25,000. That's significantly less than what you'd need to start a private foundation, which typically requires hundreds of thousands or even millions of dollars. Once your fund is established, you can contribute to it whenever you want and recommend grants to your favorite charities at your own pace. What many women don't realize is the incredible flexibility these accounts offer. You're not just limited to cash contributions. Donor-advised funds can accept appreciated assets like stocks, mutual funds, and even real estate or business interests. This creates a powerful tax-saving opportunity. Let me walk you through how this works with a real example. Say you bought $5,000 worth of stock a few years ago, and now it's worth $10,000. If you sold that stock to get cash for your donation, you'd first pay capital gains tax on the $5,000 profit. But by contributing the stock directly to a donor-advised fund, you avoid all capital gains tax and still get to deduct the full $10,000 market value on your taxes. That's essentially a double tax benefit. Inside your donor-advised fund, your contribution can be invested and potentially grow tax-free until you're ready to recommend grants to charities. Most DAF providers offer a range of investment options similar to what you'd find in a 401k or IRA, mutual funds, ETFs, and other investment vehicles that align with your goals and values. The fees for donor-advised funds typically range from 0.6% to 1% of assets under management, plus the underlying investment expenses. When shopping for a DAF provider, compare not just the fees, but also their grant-making efficiency, investment options, and minimum grant amounts. Speaking of grant amounts, this is where donor-advised funds really shine for strategic givers. Statistics show that contributions to donor-advised funds reached over $37 billion in 2021, marking a 20% increase from the previous year. People are catching on to this powerful tax tool. Take Olivia, for instance. She had been holding stock in a tech company where she previously worked. The shares had tripled in value over 5 years to $50,000. Instead of selling the stock and facing a large capital gains tax bill, Olivia contributed the shares directly to a donor-advised fund. She immediately received a $50,000 tax deduction, avoiding capital gains tax on the appreciation. For someone in the 35% tax bracket, this single move saved her over $10,000 in taxes, while allowing her to support multiple charities over the next several years. What I find most exciting about donor-advised funds is how they can transform your giving from reactive to strategic. Instead of making hasty donation decisions in December to beat the tax deadline, you can take your time researching organizations that align with your values. You can even involve your family in the grant recommendation process, turning charitable giving into a meaningful shared activity. Family tax planning, gifts that keep on giving. Beyond charitable giving, let's talk about another powerful tax strategy hiding in plain sight: giving money directly to the people you love. The government actually encourages family wealth transfers through the annual gift tax exclusion. In 2024, you can give up to $18,000 to any person you choose without triggering a single tax form or paying a penny in gift tax. That's right, completely tax-free wealth transfer. Many women I work with are surprised to learn about this opportunity. They've heard scary stories about gift taxes or assume there must be complicated paperwork involved. The reality is much simpler. This exclusion was designed to allow families to support each other without tax headaches. The beauty of this strategy is in its simplicity. You can give up to the annual exclusion amount to as many different people as you want. Have 4 children? That's potentially $72,000 in tax-free transfers each year. And if you're married, you and your spouse can combine your exclusions through gift splitting, allowing you to give up to $36,000 per recipient annually without tax consequences. Strategic gifting becomes even more powerful when you consider the tax situation of the recipient. Let's say you have investments that generate dividends or capital gains. If you're in a higher tax bracket than your adult children, transferring those assets to them could mean those investment earnings get taxed at their lower rate instead of yours. This creates a win-win. You support your loved ones while potentially reducing the overall tax burden on your family. What many people don't realize is that the government provides even more generous exclusions for certain types of gifts. When you pay someone's medical expenses or educational costs directly to the provider or institution, these payments don't count against your annual exclusion amount at all. There's no limit to these direct payments, and they don't reduce your lifetime gift tax exemption. Take Nina's story as an example. Nina, a successful business owner in her 50s, wanted to help her niece attend college without taking on student loans. Instead of giving cash directly to her niece, which would have been limited to $18,000 tax-free, Nina paid the university directly for her niece's tuition, $32,000 in a single year. Because she made the payment directly to the school, this entire amount passed completely tax-free, above and beyond her annual exclusion amount. Meanwhile, Nina still used her regular $18,000 annual exclusion to help her niece with living expenses. I was amazed to learn that I could pay unlimited amounts for education directly to the institution without any gift tax implications, Nina explained. This allowed me to make a meaningful difference in my niece's life while also being smart about reducing my taxable estate. What makes this strategy particularly powerful is how it can evolve into a multi-generational wealth transfer plan. Those small, consistent annual gifts can compound significantly over time. Imagine giving your children or grandchildren $18,000 each year that they invest over decades. These systematic transfers could build substantial wealth for your family while steadily reducing your taxable estate. Documentation is still important, even though you don't need to file a gift tax return for gifts under the annual exclusion. Keep records of your gifts, especially for medical or educational expenses paid directly to providers. These records will help substantiate that the transfers qualify for the exclusion if questions ever arise. The strategic use of these exclusions becomes even more valuable when you consider the lifetime estate tax exemption. While this exemption is quite high in 2024, $12.92 million per individual, any gifts exceeding the annual exclusion amount will reduce this lifetime limit. Staying within the annual 529 exclusion preserves your lifetime education fund for larger transfers with surprising flexibility. While those annual gift exclusions help transfer wealth directly to loved ones, there's another strategy that combines tax benefits with education funding in surprising ways. The 529 plan might be the most underutilized tax advantage in our financial system, especially for women planning for family education costs. These specialized education savings accounts allow your investments to grow completely tax-free, and withdrawals remain tax-free when used for qualified education expenses. What many don't realize is how dramatically these accounts have evolved in recent years, transforming from college-only savings vehicles into flexible financial tools. The tax benefits start immediately in many states. While there's no federal tax deduction for contributions, over 30 states offer income tax deductions or credits when you fund these accounts. For example, states like New York and Pennsylvania provide significant tax breaks just for making contributions to a 529 plan. The real magic happens with tax-free growth. Let's put this in perspective. If you contribute $5,000 annually for 18 years with a modest 6% return, your account could grow to over $150,000 by the time your child is college age. Without a 529 plan, you'd potentially owe taxes on all that growth. That's thousands in tax savings simply by choosing the right account type. What's changed dramatically in recent years is what counts as qualified expenses. The old days of 529 plans being just for college tuition are long gone. Today, these funds can cover K-12 tuition up to $10,000 annually, apprenticeship programs, student loan repayments up to $10,000 lifetime, and even qualifying expenses for trade schools and vocational training. Perhaps the most exciting recent development comes from the Secure Act 2.0, which introduced the ability to roll over unused 529 funds to a Roth IRA. This creates a remarkable safety net if your education plans change. Imagine saving for a child's education, then discovering they've earned a full scholarship. Instead of facing penalties for non-educational withdrawals, you can now potentially roll those funds into a Roth IRA, preserving the tax advantages for retirement instead. The flexibility extends to ownership and beneficiary changes too. If one child doesn't need all the funds, you can easily change the beneficiary to another family member, a sibling, cousin, or even yourself, without triggering taxes or penalties. This makes 529s powerful vehicles for multi-generational education planning. Consider Sophia's experience. Her parents started a 529 plan when she was born, contributing consistently but modestly throughout her childhood. After completing her undergraduate degree with some scholarship support, there were still substantial funds remaining in the account. Sophia later used these funds to pay for her MBA program, saving over $8,000 in taxes on the account's growth. "I had no idea how valuable this account would be for my graduate education," she explained. "What my parents started as a college fund ended up supporting my career advancement years later." What's particularly valuable is understanding the state-specific benefits, which vary widely across the country. Some states offer dollar-for-dollar tax deductions for contributions, while others provide tax credits or matching grants for lower-income families. Knowing your state's rules can significantly increase your tax advantages. For women thinking long-term about family financial planning, 529 plans offer a unique combination of tax benefits and flexibility that few other accounts can match. They allow you to support educational goals while maintaining control and adaptability as circumstances change. Home office and side business deductions, turning everyday expenses into tax savings. Now that we've explored educational tax advantages, let's turn to the place where you're probably watching this video right now, your home. That internet bill you pay each month, the electricity keeping your lights on, even that comfy chair you're sitting in. All of these everyday expenses might be partially deductible if you're one of the millions of women running a side business or working remotely. Think about it, if you're using part of your home regularly and exclusively for business purposes, the IRS actually lets you deduct those expenses. Yet most women with side hustles leave this money on the table. Why? Usually because they're afraid of triggering an audit, or they simply don't know how to properly track these expenses. Let's break down the home office deduction. To qualify, you need a space in your home that's used regularly and exclusively for business. This means if you have an extra bedroom that's only used as your office, you can deduct expenses related to that space. The IRS gives you two ways to calculate this deduction. The first is the simplified method, which lets you deduct $5 per square foot of your home office space, up to a maximum of 300 square feet. This means you could deduct up to $1,500 without tracking detailed expenses. It's quick, easy, and perfect if your home office is relatively small. The second option is the regular method, where you calculate the percentage of your home used for business. For example, if an extra bedroom is used exclusively as a home office, and it makes up 1/5 of your apartment's living space, you can deduct 1/5 of your rent and utility fees. This method typically results in a larger deduction, but requires more detailed record keeping. Beyond your actual workspace, many everyday expenses can become partial tax deductions when you have a side business. Your internet and cell phone bills, business-related vehicle mileage, shipping costs, website fees, advertising expenses, and professional publications are all potentially deductible. Even office supplies like that fancy pen set or the printer you use to mail orders can be written off. The key with mixed-use expenses is documentation. For example, if you use your cell phone for both personal and business calls, you need to track what percentage is used for business purposes. This doesn't mean keeping a log of every call. Instead, you might review a typical month and determine that about 40% of your usage is business-related. Remember that the IRS has specific rules about exclusive use. If your office is actually the kitchen table where your family also eats dinner, it probably won't qualify for the home office deduction. But a dedicated corner of your living room with a desk that's only used for business purposes might qualify. Let me tell you about Rachel, a client who turned her photography hobby into a side business. Before we worked together, she was paying taxes on almost all her photography income. After setting up proper tracking systems, she identified legitimate business expenses: her camera equipment, a portion of her rent for her home studio space, her editing software subscription, and even mileage driving to photo shoots. These deductions reduced her tax bill by $4,200, money she reinvested into better equipment that helped her land bigger clients. What makes this approach powerful is that many of these are expenses you're already paying: your internet, cell phone, and possibly even part of your rent or mortgage. With proper documentation, these everyday costs can significantly reduce your taxable income. The best part is that you can set up systems this weekend to start capturing these deductions. First, create a dedicated method for tracking business expenses, whether that's a separate credit card, a simple spreadsheet, or an app like QuickBooks Self-Employed. Second, take measurements of your home office space and calculate its percentage of your total living area. Third, start logging your business mileage with an app or a notebook in your car. These 3 simple actions could save you thousands next April. Your tax strategy roadmap, the right moves at every life stage. Setting up those systems is just the beginning of your tax strategy journey. Have you ever wondered why the tax advice your mom swears by doesn't seem to work for you? There's a simple reason. Your perfect tax strategy isn't just about finding deductions, it's about matching those strategies to your specific life stage. Think about it. A 25-year-old fresh out of college has completely different tax optimization opportunities than a 45-year-old at their peak earning years. Using the wrong strategies at the wrong time isn't just ineffective, it could actually cost you money. Let's break down what this looks like across your financial life. In your 20s, your focus should be on establishing tax-advantaged foundations. The standard deduction, $14,600 for single filers in 2024, will likely cover most of your expenses, so you'll want to look beyond basic deductions to credits and specific tax-advantaged accounts. The Earned Income Tax Credit is particularly powerful for lower-income earners in their early career, potentially providing a refund that exceeds what you paid in taxes. If you're still in school or recently graduated, the American Opportunity Tax Credit could reduce your tax bill by up to $20,500 per student for education expenses. For 20-somethings, Roth accounts are usually your best friend. Since you're likely in a lower tax bracket now than you will be later, contributing to a Roth IRA means you pay relatively low taxes now for completely tax-free withdrawals in retirement. Health savings accounts, HSAs, are another overlooked opportunity. They offer the rare triple tax advantage of pre-tax contributions, tax-free growth, and tax-free withdrawals for medical expenses. As you transition into your 30s and 40s, your tax strategy should evolve. Now that you're earning more, traditional retirement accounts like 401ks and IRAs become increasingly valuable since they reduce your taxable income in the years when you're likely hitting higher tax brackets. Flexible spending accounts can help you manage family healthcare expenses with pre-tax dollars, especially useful when you're juggling childcare costs. For those with growing families, the 529 plan becomes a key tax strategy. This tax-advantaged savings plan for education costs creates a powerful way to prepare for your children's future while potentially getting state tax deductions today. By your 40s and 50s, you're typically in your peak earning years, and tax strategy becomes even more crucial. This is when techniques like tax loss harvesting and strategic charitable giving really shine. With higher income, you'll likely itemize deductions, making charitable contributions more valuable from a tax perspective. If you're over 50, catch-up contributions allow you to add extra money to retirement accounts beyond the standard limits. This is particularly valuable for women who may have taken career breaks for caregiving and need to boost their retirement savings. Let me share a quick example of how this life stage approach works. Melissa, a 26-year-old graphic designer, focused on maximizing her Roth IRA and HSA contributions while claiming the remaining student loan interest deduction. This approach saved her about $3,700 in taxes. Meanwhile, Catherine, a 42-year-old marketing director, prioritized her traditional 401k, Backdoor Roth contributions, and 529 plans for her children's education, reducing her tax bill by over $11,000. The key is creating a tax strategy roadmap that grows with you. Think about setting up an annual tax strategy review each January to reassess your approach based on your current life stage. By aligning your tax strategies with your specific age, income level, and family situation, you'll save thousands more than someone using a one-size-fits-all approach. Tax avoidance versus tax evasion, staying on the right side of the line. Now that you've got your life stage tax strategy in place, let's talk about something that keeps many women from claiming the tax breaks they deserve. There's a world of difference between tax avoidance, completely legal, and tax evasion, definitely not legal. And understanding this distinction isn't just about staying out of trouble. It's about confidently claiming every legitimate deduction you're entitled to. Many women I've worked with hesitate to take perfectly legal deductions because they're afraid of crossing an invisible line. But here's the reality. Tax avoidance is simply using legal methods to reduce your tax burden. The government actually builds these opportunities into the tax code intentionally. They're not loopholes, they're pathways. Let me break this down clearly. Tax avoidance includes strategies like contributing to retirement accounts, claiming business expenses for your side hustle, or timing your investment sales strategically. These are all perfectly legal ways to reduce what you owe. On the flip side, tax evasion involves deliberately hiding income or creating fake expenses. This might look like getting paid in cash and not reporting it, claiming personal expenses as business deductions when they're clearly not related to your business, or creating fake receipts for donations you never made. These actions cross the line into illegal territory. The difference often comes down to documentation and intent. When you're practicing legal tax avoidance, you maintain clear records that support your tax position. For business expenses, this means keeping receipts, noting the business purpose of meetings or travel, and having a system that separates personal from business expenses. For charitable donations, it means having proper acknowledgement letters from organizations. Documentation is your shield. If you can back up every deduction with proper records, you can respond confidently to any questions from the IRS. This is especially important in gray areas where personal and business use might overlap, like your cell phone or home internet when you work remotely. The IRS has specific doctrines they use to evaluate questionable situations. They look at whether transactions have economic substance beyond just avoiding taxes and whether there's a legitimate business purpose. When making tax decisions in uncertain territory, ask yourself, would this make sense if tax benefits weren't a factor? If the answer is yes, you're likely on solid ground. I want to share Vanessa's story because it highlights something I see all the time. Vanessa runs a small online business selling handmade jewelry. For years, she was so afraid of an audit that she avoided claiming legitimate business expenses. She worked from a dedicated room in her apartment, but never took the home office deduction. She used her personal car for supply runs and deliveries, but never tracked her business mileage. When we reviewed her taxes together, we found $6,500 in completely legitimate deductions she had missed out on. That's money that could have gone toward expanding her business or building her emergency fund. The fear of crossing that line between avoidance and evasion had cost her thousands. What made the difference for Vanessa was understanding that proper documentation creates confidence. Now she keeps a simple digital folder with photos of receipts, maintains a business mileage log on her phone, and has a separate credit card for business expenses. These simple systems mean she can claim every deduction she deserves without worry. Remember, the IRS audits only about 0.4% of individual tax returns. While that percentage increases for higher income taxpayers or those with business income, proper documentation means you can approach even an audit with confidence rather than fear. 3 simple actions to start your tax strategy today. That fear of audits we just talked about, it often prevents women from taking the most powerful first steps in tax planning. What if implementing just 3 straightforward actions could put $3,700 back in your pocket next year without raising any red flags? I get it. The strategies we've covered might feel overwhelming. When faced with so many options, it's easy to freeze up and do nothing. But here's the truth about tax planning. You don't need to master everything at once. Tax strategy isn't a once-a-year scramble in April. It's an ongoing practice of small, intentional moves throughout the year. Let's break this down into 3 simple weekend actions that can transform your tax situation without requiring an accounting degree. First, schedule a 30-minute appointment with your company's HR department to discuss optimizing your retirement contributions. This conversation is crucial because your HR team can walk you through all available retirement plans and help you maximize contributions based on your specific situation. They can explain your company's matching policy, if they have one, outline contribution limits, and even set up automatic increases to your contributions. This single meeting could identify thousands in potential tax savings through pre-tax contributions you're currently missing. Second, set up a simple system for tracking potential tax deductions. This doesn't need to be complicated. Apps like Expensify or QuickBooks can automatically organize receipts and categorize expenses, or you can create a basic spreadsheet with categories like charitable donations, business expenses, and medical costs. The key is creating a system that works with your lifestyle. Take photos of receipts immediately after purchases. Use a dedicated credit card for deductible expenses or set a weekly 15-minute appointment to update your records. This proactive approach ensures you won't scramble to reconstruct a year's worth of potential deductions next April. Third, review last year's tax return with fresh eyes to identify missed opportunities. Look for unclaimed deductions or credits in areas like medical expenses, charitable contributions, or business-related costs. Make notes of questions to ask when you schedule a consultation with a tax professional. When meeting with them, bring your notes and specifically ask about strategies aligned with your life stage and income level. A good tax professional can spot patterns and opportunities you might miss on your own. I recently worked with Jamie, a marketing manager who implemented just these 3 actions after feeling overwhelmed by tax planning. During her HR meeting, she discovered her company offered a health savings account she wasn't utilizing, allowing her to contribute $3,600 pre-tax. Setting up a simple tracking system helped her identify $4,200 in legitimate business expenses from her side consulting work. And reviewing her previous return with a tax professional uncovered an unclaimed education credit worth $1,500. All told, these 3 weekend actions saved Jamie $3,700 on her taxes the following year. The magic of tax strategy isn't just in the immediate savings, it's in the compounding effect over time. The knowledge you gain from these initial steps builds on itself year after year. Small tax savings invested wisely grow exponentially. More importantly, these actions create momentum that carries forward, making each subsequent tax season easier and more financially beneficial. Here's what makes these strategies so powerful. They're completely legal ways to pay less in taxes without breaking any rules. The tax code isn't just a set of restrictions. It's a roadmap showing you exactly which actions the government wants to incentivize. When you align your financial decisions with these incentives, you're simply following the map as intended. The confidence factor. Why understanding taxes changes everything. When you stop viewing the tax code as a complex obstacle and start seeing it as a strategic roadmap, something remarkable happens to your financial confidence. Studies show that 65% of people who understand basic tax principles report feeling more in control of their financial futures, compared to just 30% of those who remain in the dark. This confidence gap doesn't just affect your tax bill, it transforms every financial decision you make. Think about this. Knowledge creates freedom. When you understand the tax implications of your choices, you suddenly have permission to make decisions based on what's truly best for you, rather than what you fear might trigger problems. Financial advisor Craig Ferrantino puts it perfectly. Understanding the tax code and how it applies to your investments can lead to substantial savings and better financial outcomes. It's not just about making money, it's about keeping more of what you earn. This confidence ripples out in surprising ways. That research from the Journal of Financial Counseling and Planning shows that higher financial literacy directly correlates with lower levels of financial stress and anxiety. Imagine approaching your finances with curiosity instead of dread. When tax season arrives, you're not scrambling to organize receipts or worrying about making mistakes. You're confidently implementing the strategy you've been building all year. The benefits extend far beyond April 15th. Women who understand tax implications make different career decisions. That National Endowment for Financial Education survey found something fascinating. 70% of people reported that financial knowledge positively impacted their job performance and career advancement. When you understand how taxes work, you can accurately evaluate job offers, negotiate better compensation packages, and make strategic decisions about timing your career moves. Your investment choices transform too. The American Economic Association study revealed that investors who understand tax implications are 30% more likely to engage in long-term investing. Instead of making reactive decisions based on market fluctuations, you start making proactive choices, aligned with tax-efficient strategies. You begin to see the market differently, noticing opportunities others miss because they don't understand the tax advantages. This knowledge gap particularly affects women. According to the Global Financial Literacy Excellence Center, women are 20% less likely than men to feel confident in their investment knowledge. This confidence gap leads directly to lower participation in investment opportunities. But here's the good news. This gap can be closed through education. The National Women's Law Center study found that women who participated in financial education programs felt 50% more confident in managing their finances effectively. I've seen this transformation firsthand. One client, Melissa, started as a reluctant investor who avoided making financial decisions because she feared the tax implications. After learning about capital gain strategies and retirement account options, she completely changed her approach. Now she confidently maximizes her HSA, strategically harvests tax losses during market downturns, and even helped her parents set up a donor-advised fund. The knowledge didn't just save her money, it made her the financial role model in her family. When you understand taxes, financial news and policy changes take on new meaning too. Instead of feeling confused or threatened by tax legislation updates, you can quickly identify how changes might affect your personal situation and adjust your strategy accordingly. You become an active participant in your financial story rather than a passive observer. The Journal of Economic Psychology study confirms what I've seen in practice. Individuals with higher financial literacy engage in more positive financial behaviors like budgeting and saving. These behaviors create a positive feedback loop. Each success builds confidence, leading to more informed decisions, creating better financial outcomes. The ultimate benefit isn't measured in dollars saved, though that's certainly nice. It's about the freedom that comes from financial confidence, the ability to make choices based on what you truly want rather than what you fear. When you master tax strategy, you're not just saving money, you're claiming your financial power. We've journeyed through the tax landscape together, and I hope you're seeing taxes in a new light now. Remember, taxes aren't just numbers on a form. They're a reflection of the life you're building and the values you hold dear. As Benjamin Franklin once said, the best way to predict your future is to create it. This applies perfectly to tax strategy. Taking control puts you in the driver's seat of your financial future. I've created a comprehensive tax strategy checklist that's yours to download. It organizes all these strategies by life stage and income level, making implementation straightforward. Take 30 minutes this week to review just one area of your taxes, perhaps retirement contributions or potential deductions you've missed. Schedule a consultation with a tax professional who can personalize these strategies for your situation. You don't need to